There is a single question that separates the fortunes of the careful investor from the ruins of the naive. It is a question so simple, so profoundly human, that it is often dismissed in a world obsessed with complex financial models, with earnings projections calculated to the fourth decimal place, and with the chaotic noise of second-by-second market fluctuations. Yet ignoring this question is the single most common reason why portfolios are destroyed, why retirement dreams evaporate into dust, and why seemingly invincible corporations crumble overnight. The question is not what are the earnings or what is the growth rate. The question, as posed by the most successful investor in human history, is this: are you willing to have any contemplated act appear on the front page of your local paper to be read by your spouse, children, and friends? This is the final promise. This is the bedrock of Warren Buffett's entire philosophy. It's a concept he calls the newspaper test, and it serves as the ultimate firewall against the single greatest danger in the world of finance: the brilliant, charismatic, and utterly immoral chief executive. Character, you see, is capital. It is the most valuable yet most unquantifiable asset on any balance sheet. And today, we are going to learn how to measure it. We will deconstruct this principle, not as a vague platitude, but as a rigorous, actionable tool for due diligence, a weapon for portfolio protection that can shield you from the catastrophic risk of financial fraud and reputational collapse. This is not about sentimentality. It is about the cold, hard mathematics of survival and success in a world where management integrity is the ultimate competitive advantage. Our journey begins with the foundational pillar of this entire philosophy: understanding the newspaper test not as a moral suggestion but as the ultimate non-negotiable filter for every investment decision. It is the first line of defense, the gatekeeper that determines whether a company is even worthy of further stock analysis. To truly grasp its power, we must travel back to a moment of crisis, a time when one of the most powerful firms on Wall Street was teetering on the brink of oblivion, brought to its knees by a failure of character at the very top. The year was 1991. The firm was Salomon Brothers, a titan of the bond market, a place where fortunes were made and lost with staggering speed. Berkshire Hathaway was Salomon's largest shareholder, holding a $700 million stake in preferred stock, an investment that was suddenly at risk of becoming worthless. The scandal that erupted was a textbook case of corporate hubris. A senior trader, Paul Moser, had been systematically submitting false bids in U.S. Treasury auctions to corner the market, a flagrant violation of federal law. This wasn't just a rogue employee. It was a symptom of a culture that prized profits above all else. The initial crime was bad enough, but the true failure of management integrity came next. The firm's top executives, including the formidable CEO John Gutfreund, known as the King of Wall Street, learned of Moser's actions in April. For months, they did nothing. They sat on the information. They failed to report the illegal activity to the authorities. They failed the newspaper test in the most spectacular way imaginable. When the scandal finally broke in August, the fallout was apocalyptic. The U.S. Treasury banned Salomon from bidding in its auctions, a death sentence for a bond-trading powerhouse. Their clients, the largest financial institutions in the world, began pulling their business. The firm was facing a full-blown liquidity crisis, a bank run at the highest level of finance. The stock price was in freefall, and Warren Buffett, sitting in Omaha, saw his $700 million investment evaporating. But more than that, he saw the reputation of a historic firm, and by extension his own reputation as an investor, being dragged through the mud. The situation was so dire that the U.S. Treasury Secretary, Nicholas Brady, called Buffett and told him that if Salomon Brothers went under, the contagion could destabilize the entire global financial system. The pressure was immense. John Gutfreund and the other top executives were forced to resign in disgrace. In the chaos, the board turned to the one man they believed could save the firm, its largest and most famous shareholder. Warren Buffett was asked to step in as the interim chairman and CEO of Salomon Brothers. He didn't want the job. He was an investor, a long-term investing specialist from Omaha, not a Wall Street cleanup crew. But his own capital and his reputation were on the line. He agreed. What happened next is a masterclass in the application of the newspaper test under the most intense pressure imaginable. On his first day, Buffett addressed the thousands of terrified Salomon employees via the firm's internal broadcast system. His message was not about complex financial restructuring or legal strategy. It was about a single, simple idea. He said, and these words should be etched into the mind of every investor and every executive: lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless. This was the newspaper test made manifest. He was drawing a line in the sand. The old culture of pushing the envelope, of doing whatever it took to make a buck, was over. The new culture would be judged by a single standard. Could you defend your actions on the front page of the Wall Street Journal? Buffett immediately went on the offensive, not with lawyers, but with transparency. He went to Washington and testified before Congress, admitting the firm's wrongdoing without excuse or equivocation. He cooperated fully with regulators. He fired those involved and installed new systems of corporate governance and risk management to ensure it could never happen again. He was performing triage on the firm's reputation, understanding that without it, no amount of financial engineering could save it. His actions demonstrated a core belief: trust is easier to maintain than it is to regain. The public, the regulators, and the market saw this transparent, brutally honest approach and began to believe that the rot was being cut out. Slowly, painstakingly, confidence was restored. The Treasury lifted its ban. Clients returned. Salomon Brothers was saved from the abyss. For Buffett, the Salomon scandal was not just a financial crisis. It was a defining test of his principles. He saw firsthand how a lapse in CEO character, a failure to ask that simple question about the front page, could bring a multi-billion-dollar empire to the brink of extinction in a matter of weeks. This anecdote isn't just a story. It's the foundational proof of why character isn't a soft skill. It is the hardest financial asset a company possesses. The psychological principle underpinning the immense power of the newspaper test is a concept known as shame aversion, leveraged against the powerful tide of groupthink. Inside many corporate cultures, a dangerous psychological bubble forms. Decisions are made in insulated conference rooms, surrounded by people who all share the same assumptions, the same goals, and the same pressures to hit quarterly numbers. This environment is a perfect breeding ground for what social psychologist Solomon Asch demonstrated in his famous conformity experiments. In those studies, people would knowingly give a wrong answer to a simple visual test simply because everyone else in the room, who were secretly actors, gave the same wrong answer. The pressure to conform, to not rock the boat, is a powerful human impulse. This is the seed of corporate scandal. An executive sees a questionable accounting practice. Their gut tells them it's wrong, that it's designed to mislead rather than inform. But their boss approves it. The chief financial officer signs off on it. The team celebrates the great quarter it produces. In this bubble, the unethical choice becomes the socially accepted choice. The path of least resistance is to conform. The newspaper test is a psychological tool designed to violently shatter this bubble. It forces the decision-maker to step outside their insulated group and to view their actions through the eyes of an objective and often critical outsider, society itself, represented by the press. It externalizes the conscience. Suddenly, the audience is no longer a handful of like-minded colleagues. It's your neighbors, your parents, your children. The cognitive bias being short-circuited here is the self-serving bias, the tendency for people to attribute positive events to their own character but attribute negative events to external factors. Inside the bubble, a risky decision that works out is seen as bold leadership. If it fails, it's an unforeseeable market event. The newspaper test preempts this rationalization. It forces you to imagine the negative outcome, the public shaming, the destruction of your personal reputation, before you even act. Shame is a profoundly powerful and primal human emotion. We are social creatures, hardwired to seek approval and avoid ostracism. The fear of being publicly shamed for a dishonest or unethical act can be a far more potent deterrent than the abstract fear of a fine or a lawsuit down the road. It makes the consequences immediate and visceral. When a CEO considers a decision, they are not just weighing profit and loss, they are weighing the pride of seeing their name in the paper for a brilliant move against the burning shame of seeing it there for a scandal. This is the essence of effective risk management on a personal, human level. It's not about rules and a compliance manual. It's about an internal compass calibrated to the judgment of the outside world. So how can we, as individual investors performing our own due diligence, translate this powerful concept into a practical, repeatable mental model? We can call it the front page filter, a blueprint for evaluating not just our own decisions, but the past and potential future decisions of the management teams we entrust with our capital. It consists of 5 distinct steps. Step 1. Define the decision with brutal honesty. When analyzing a company, look for a pivotal, controversial, or overly complex decision they have made. This could be a large acquisition, a sudden change in accounting policy, or a massive stock buyback program when the company is already heavily in debt. Don't accept the corporate jargon used to describe it. Translate it into plain English. For example, the company is using billions in borrowed money to buy a competitor in a completely different industry, which will triple the CEO's compensation. Step 2. Imagine the skeptical journalist. Picture a sharp, intelligent, and slightly cynical reporter from a reputable source like the Wall Street Journal or Bloomberg. This journalist has no loyalty to the company. Their only goal is to find the unvarnished truth and write a compelling story. Now write the headline for their article about this decision. Avoid promotional language. A good headline might be, CEO bets the farm on unrelated industry as core business stagnates, not company announces bold strategic acquisition. Step 3. Write the first paragraph. The first paragraph of any news story contains the most critical information: the who, what, where, when, why, and how. Draft this paragraph from the perspective of the journalist. Include the key numbers, the price of the acquisition, the amount of debt taken on, the details of the executive bonus structure. Crucially, you must also include the potential downsides and the criticisms from skeptics. A good model forces you to argue against yourself. This step is a powerful tool for piercing through the fog of corporate public relations. Step 4. The family and mentor test. Imagine reading this mock news article, which you have written with journalistic objectivity, to 2 people: a member of your family who you love and respect, and a professional mentor whose opinion you deeply value. As you read it aloud, pay close attention to your own feelings. Do you feel a sense of pride and excitement, or a knot of anxiety and embarrassment in your stomach? Does the decision sound like a clever and prudent act of value creation, or a reckless gamble? This step connects the analytical process to your intuition and your own ethical framework. Step 5. Assess the emotional verdict. The final step is to make a judgment based on that feeling. If the exercise leaves you feeling proud, confident, and willing to defend the action, the decision passes the front page filter. It suggests a high degree of management integrity. If it leaves you feeling ashamed, defensive, or simply uneasy, the decision fails. This is a major investment red flag. It indicates that the management team is likely operating inside a bubble, prioritizing short-term gains or personal enrichment over long-term sustainable and defensible value creation. This blueprint takes the abstract idea of ethical investing and turns it into a concrete analytical process. Now, let's explore the antithesis, the path walked by the 99% of managers and investors who ignore this fundamental principle. Their world is governed by the just this once fallacy, a cognitive trap that leads down a slippery slope to ruin. It starts small. The thinking is not, let's commit financial fraud. It's far more insidious. It's a manager facing pressure to meet Wall Street's quarterly earnings estimates. They're just a little bit short, so they decide to pull forward some sales from the next quarter. It's not technically illegal, it's just aggressive accounting. They tell themselves it's just this once to get through a tough period. But the next quarter, they have an even bigger hole to fill, and the practice is repeated. Each small, rationalized compromise makes the next one easier. The ethical line, once crossed, becomes blurred and then erased. This is the path of focusing on what is legal rather than what is right. The 99% of managers ask their lawyers, "Can we do this?" The exceptional manager, the Buffett-style manager, asks, "Should we do this?" The focus on mere legal compliance is a massive red flag for any investor conducting due diligence. It suggests a culture that seeks to exploit loopholes rather than a culture that seeks to build trust. An example of this is the widespread use of non-GAAP earnings. Companies will report their official, legally required GAAP, generally accepted accounting principles earnings, and then they will present a second, adjusted or pro forma number that conveniently excludes all sorts of real costs, like stock-based compensation or restructuring charges. The 99% of investors latch on to this rosier, adjusted number because it makes the company look more profitable. They ignore the fact that stock-based compensation is a very real expense that dilutes their ownership. They fall for the story, not the reality. The manager who relies on these adjustments is failing the newspaper test. The headline would read, "Company claims record profits by ignoring billions in real costs." Would they be proud to read that? Of course not. But by operating within the bubble of Wall Street's short-term focus, they get away with it, until they can't. The just this once fallacy inevitably snowballs as small accounting tricks become larger ones, until the gap between reported reality and economic reality is so vast that it collapses under its own weight, leading to sudden catastrophic stock price declines. This is the path of the 99%, a slow, creeping erosion of business ethics that ends in a fast and brutal financial reckoning. The direct financial connection between management integrity and shareholder returns can be seen most clearly in the intangible, yet immensely valuable, concept of goodwill. On a company's balance sheet, goodwill represents the premium paid for an acquisition over the fair market value of its assets. In reality, it's a placeholder for intangible things like brand reputation, customer relationships, and intellectual property. At its core, a huge portion of goodwill is a bet on the integrity and quality of the acquired company's culture and management. When a failure of CEO character occurs, that goodwill can be wiped out in an instant. A scandal forces the company to take massive impairment charges, writing down the value of that goodwill on the balance sheet. This isn't just an accounting entry. It's a direct admission that the company overpaid for an asset whose reputation, and therefore its earning power, has been permanently damaged. This directly reduces the company's book value, and, by extension, its stock price. But the damage goes deeper. A company with a reputation for high management integrity enjoys a lower cost of capital. Lenders give them better terms on debt because they are seen as a lower credit risk. Investors are willing to pay a higher price-to-earnings multiple for the stock because they have confidence in the reported numbers and trust that the management will act in their best interests. This integrity premium is a massive, tangible financial advantage. Conversely, when a scandal erupts, the cost of capital soars. Lenders demand higher interest rates to compensate for the new risk. The stock's PE multiple collapses as investors flee, no longer trusting the numbers or the people in charge. Suddenly, the entire financial architecture of the business becomes more expensive and more fragile. A clear example is to compare two companies. Company A is run by a founder CEO known for transparent shareholder relations and a history of prudent capital allocation. Company B is run by a hired-gun CEO known for aggressive accounting and a history of value-destroying acquisitions. Even if their current earnings are identical, Company A will trade at a PE of 25, while Company B will trade at a PE of 15. That 10-point difference in multiple is the market's quantifiable price for CEO character. It is the direct financial manifestation of the newspaper test. Passing it builds a fortress of value. Failing it invites a siege that can leave a portfolio in ruins. Having established the newspaper test as our primary filter, we must now move to our second pillar, learning to read the invisible language of leadership, to look beyond the pristine numbers on a balance sheet and discern the true character of the people in charge. This is the art of qualitative stock analysis, and no story illustrates it better than Warren Buffett's purchase of the Nebraska Furniture Mart from Rose Blumkin, a diminutive Russian immigrant who built a retail empire in Omaha. In 1983, Buffett approached Mrs. B, as she was universally known, with an offer to buy her business. The negotiation was legendary in its simplicity. Buffett asked her price. She named a number. He said okay. The deal was sealed with a handshake. What's astonishing is what came next. Buffett bought the company, which was doing $60 million a year in sales, based on nothing more than his conversation with Mrs. B and his observation of her character. There were no audited financials. There was no army of investment bankers conducting months of due diligence. There was just a 2-page contract that Buffett wrote himself. Why would a man so famously obsessed with numbers, who preached the gospel of understanding a company's financials inside and out, make such a massive bet based on a gut feeling? Because it wasn't a gut feeling, it was a calculated assessment of character. Buffett had watched Mrs. B for years. He saw a woman who was fanatically dedicated to her customers, famously living by the motto, "Sell cheap and tell the truth." He saw her incredible work ethic, still haggling with carpet salesmen on the floor in her 90s. He saw her frugality. The company's headquarters were modest, with no corporate extravagance. He saw her passion. The business wasn't a job for her, it was her entire life. Most importantly, he saw that her incentives were perfectly aligned with his. She wasn't looking to cash out and retire to a beach. She agreed to sell only if she could keep running the business, working every day. She was an owner-operator in the truest sense of the word. Buffett wasn't just buying a furniture store. He was buying a management system, a culture of integrity and customer focus embodied by one person. He knew that with Mrs. B at the helm, the business would be run with the same care and prudence as if she still owned 100% of it. The audited financials were secondary because he had audited her character and she had passed with flying colors. This anecdote teaches us a profound lesson in quality investing. The numbers on a financial statement are the result of management decisions. If you can accurately assess the character of the decision makers, you can predict the quality of the future results. Reading the invisible language of leadership is about understanding the cause, not just observing the effect. The psychological trap that prevents most investors from making this kind of assessment is a powerful combination of the halo effect and confirmation bias. The halo effect is a cognitive bias where our overall impression of a person influences how we feel and think about their character. In investing, this is often triggered by a charismatic CEO with a compelling story. A leader who is articulate, confident, and presents a grand vision for the future casts a halo that makes investors assume they are also competent, honest, and prudent. Think of the tech visionaries who promise to change the world. Their charisma creates a positive glow that can blind investors to underlying problems in corporate governance or business ethics. Once this halo is in place, confirmation bias kicks in. This is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's prior beliefs. An investor who is impressed by a CEO's vision will then unconsciously seek out evidence that supports this positive view. They'll focus on the rising stock price, read the glowing media profiles, and dismiss negative information, like reports of high executive turnover or questionable accounting, as just noise or the complaints of haters. This creates a dangerous feedback loop. The halo makes you like the CEO, and confirmation bias makes you find reasons to keep liking them, ignoring the investment red flags that are often hiding in plain sight. Warren Buffett masterfully inverts this process. He actively fights the halo effect. He is famously skeptical of slick, promotional CEOs. He prefers managers who are straightforward, humble, and even a bit boring. He looks for signs of integrity first. He wants to see a long track record of honest dealings and rational capital allocation before he even allows himself to get excited about the business model. By starting with a critical assessment of CEO character, he prevents the halo from ever forming. This allows him to analyze the business and its financials with cold objectivity. He is not looking for information to confirm a positive first impression. He is actively searching for any piece of data that might reveal a flaw in a manager's character or judgment. This discipline of inverting the common psychological process is a cornerstone of effective risk management and a key differentiator between amateur and professional long-term investing. To operationalize this, we can develop an applied mental model called the scuttlebutt due diligence checklist, a term borrowed from investing legend Philip Fisher and heavily used by Buffett and Munger. It's a systematic process for gathering qualitative data on management integrity that goes far beyond the official corporate filings. There are 4 key areas to investigate. First, read the transcripts. Go back and read at least 10 years of the company's annual shareholder letters and quarterly earnings call transcripts. You are not looking for financial data. You are looking for patterns in communication. Is the language clear, simple, and direct, or is it filled with confusing jargon and buzzwords? A CEO who uses plain language is more likely to be thinking clearly. Does the CEO consistently admit mistakes and take responsibility for failures? A leader who is willing to be publicly self-critical is demonstrating a high degree of intellectual honesty and respect for shareholder relations. Or do they always blame bad results on external factors? This is a huge red flag. Second, scour the footnotes. The footnotes to the financial statements are where companies are legally required to disclose the details they'd rather you didn't pay attention to. This is where you hunt for signs of potential financial fraud or misaligned incentives. Look for sudden changes in accounting policies, the existence of complex off-balance sheet entities, or unusually large and complicated executive compensation packages. If you can't understand it, it's probably designed to be not understood, which is a failure of corporate governance in itself. Third, talk to the ecosystem. This is the heart of scuttlebutt. You must go beyond what the company tells you and find out what other people think. If possible, try to talk to former employees. What was the culture really like? Was the CEO respected or feared? Talk to the company's competitors. Do they respect the company as a tough but fair player, or do they view it as unethical? Talk to the company's key suppliers and customers. Does the company have a reputation for being a reliable partner, or for squeezing every last penny out of its relationships? The mosaic of opinions you gather from this ecosystem provides a far more accurate picture of CEO character than any polished annual report. Fourth, track the record of capital allocation. This is the ultimate test. A CEO's primary job is to allocate the company's capital to generate the best possible long-term returns. Analyze their history. Have they spent billions on overpriced, ego-driven acquisitions that subsequently had to be written down? Or have they demonstrated discipline, only buying businesses at sensible prices and wisely repurchasing company shares when they were trading below intrinsic value? A CEO's capital allocation record is a detailed diary of their business judgment and their commitment to shareholder value. Following this checklist transforms the fuzzy concept of character into a set of observable, verifiable data points. The antithesis to this deep qualitative analysis is what we can call the visionary CEO trap. This is the mistake made by the 99% of investors who chase charismatic storytellers. They become enthralled with a grand vision and believe that the power of the idea and the personality of the leader can overcome any and all flaws in execution, governance, or ethics. They fall in love with the narrative. The perfect example of this is Adam Neumann at WeWork. The vision was intoxicating: to elevate the world's consciousness by revolutionizing the nature of work. He was a masterful storyteller, and investors, including some of the most sophisticated private equity and venture capital firms in the world, lined up to give him billions of dollars. They were investing in the halo, but while they were mesmerized by the vision, they ignored the glaring investment red flags in his character and the company's corporate governance. Neumann had a history of self-dealing, leasing properties he personally owned back to the company. He cashed out hundreds of millions of dollars in stock before the company had ever turned a profit. The company's internal culture was reportedly chaotic and extravagant. The business model itself was a simple, unprofitable office leasing business masquerading in the language of a high-tech platform. Investors who followed the scuttlebutt checklist would have failed WeWork on every single point. The language was filled with jargon, not clarity. The corporate governance structure was designed to give Neumann absolute control, not to protect shareholders. The ecosystem of former employees and real estate professionals would have painted a picture of hubris and chaos. And the capital allocation was abysmal, burning through billions in cash with no clear path to profitability. The 99% bought the story. They fell into the visionary CEO trap. The result was one of the most spectacular corporate implosions in recent history, with a valuation that plummeted from $47 billion to near bankruptcy, wiping out fortunes in the process. This serves as a brutal reminder that a powerful vision combined with a flawed character is not a recipe for success. It's a recipe for a bubble waiting to pop. The direct financial connection here can be understood as the trust premium embedded in a company's valuation. The market is not just a cold, calculating machine processing earnings data. It is also a collective judgment on the quality and reliability of those earnings. A company run by a management team with a decades-long track record of integrity, transparency, and intelligent decision-making is perceived as having lower risk. Its future earnings are seen as more predictable and sustainable. As a result, investors are willing to pay a higher price for those earnings. They apply a lower discount rate to the company's future cash flows, which mathematically results in a higher present value and thus a higher stock price. This trust premium is a tangible financial asset built over years of consistent, ethical behavior. Consider two identical manufacturing companies. Both earn $100 million per year. Company A is run by a CEO who has been with the company for 30 years, writes candid shareholder letters, has a modest salary, and has a history of making smart, small acquisitions. Company B is run by a new, high-profile CEO who is paid an enormous salary, constantly appears on television, and just announced a massive, debt-fueled, transformative merger. Even with identical earnings, the market will value them differently. Company A might trade at 20 times earnings, giving it a market capitalization of $2 billion. Company B, with its higher perceived risk from an unproven CEO and a risky merger, might trade at only 12 times earnings for a market cap of $1.2 billion. That $800 million difference is the market's trust premium. It is the quantifiable value of a sterling reputation for management integrity. By learning to read the invisible language of leadership, you are learning to identify the companies that deserve this premium, allowing you to invest in businesses whose value is supported not just by their current earnings, but by the bedrock of their character. This is the secret to true quality investing. This brings us to the third and perhaps most crucial pillar in our structure: understanding the profound difference between a manager with an owner's mindset and one who is merely a hired hand. This distinction gets to the very heart of aligning incentives, a topic that obsessed Warren Buffett and is the key to unlocking true long-term investing success. The archetype for the owner's mindset is Tom Murphy, the former CEO of Capital Cities/ABC. Buffett has repeatedly called Murphy the greatest business manager he has ever known. His story is not one of flashy innovation or daring technological breakthroughs. It's a story of relentless rationality, humility, and a deep-seated belief that the company's money was his money. Capital Cities started as a single, bankrupt television station in Albany, New York. Over several decades, Murphy, along with his partner Dan Burke, built it into a media empire that eventually acquired the much larger ABC network. Their method was simple but revolutionary. They ran a radically decentralized organization. They believed in hiring the best possible people, giving them clear goals, and then getting out of their way. They trusted their managers completely. Headquarters was famously tiny, a handful of people in a modest New York office. They were fanatical about cost control, not out of stinginess, but because they viewed every dollar of company expense as a dollar that could have been returned to shareholders. But their true genius was in capital allocation. They were masters of buying media properties at fair prices, improving their operations, and using the prodigious cash flow to buy more properties or return cash to shareholders. In 1986, when they bought ABC, Wall Street was aghast. How could this small, frugal company possibly manage such a behemoth? But Murphy and Burke applied their owner's mindset, slashing corporate waste, empowering talented executives, and focusing relentlessly on profitability. The results were astounding. A dollar invested with capital cities in 1957 was worth over $2,000 30 years later, a compounding machine driven by management that thought and acted like owners because they were significant owners. Their personal fortunes were tied directly to the long-term success of the business, not to the size of their annual bonus. They weren't just managing the company, they were stewarding their own capital alongside their shareholders. This is the gold standard of management integrity and the alignment of interests. The psychological principle that makes this distinction so critical is known as the principal-agent problem. This is one of the most fundamental concepts in economics and corporate governance. The principals are the owners of a company, the shareholders. The agent is the person they hire to run the company on their behalf, the CEO. The problem arises because the agent's interests may not be perfectly aligned with the principal's interests. The shareholders, principals, want to maximize the long-term intrinsic value of the business. The CEO agent, however, might be more interested in maximizing their own salary, building a larger corporate empire to increase their prestige, even if it's unprofitable, or enjoying lavish corporate perks like private jets and opulent offices. The most common tool used to solve this problem, the stock option, has often made it worse. Granting a CEO millions of stock options seems like it should align their interests with shareholders. But it often creates a perverse incentive to focus on short-term stock price movements rather than long-term value creation. A CEO might take on excessive debt to buy back shares, temporarily boosting the earnings per share and the stock price, allowing them to cash in their options at a high price right before the consequences of that excessive debt become apparent. They might also engage in aggressive accounting to meet quarterly targets, again manipulating the stock price in the short term. This is incentive-caused bias in its most dangerous form. A manager with a true owner's mindset, like Tom Murphy, is not primarily motivated by the structure of their bonus plan. They are intrinsically motivated by a deep-seated passion for the business itself and a psychological identification with the other owners. They feel the pain of a wasted dollar in their gut, not just on a spreadsheet. They derive satisfaction from building something enduring and valuable, not just from cashing a check. Identifying this intrinsic motivation is a key piece of due diligence, separating the stewards of capital from the mere extractors of it. To translate this into a practical tool, we can use the incentive audit framework. This is a four-part mental model for dissecting whether a management team truly thinks like an owner or is simply a well-compensated hired hand. Part 1 is the skin-in-the-game test. Look at the CEO's holdings in the company. The critical question is not how many shares they own, but how they acquired them. Are their holdings composed almost entirely of stock options and restricted stock units granted to them by the board? Or have they taken a significant amount of their own cash from their own bank account and purchased shares on the open market, just like any other investor? A CEO who buys a large number of shares with their own money is sending an incredibly powerful signal. They are not just an employee, they are a true partner. Part 2 is the compensation structure analysis. Read the proxy statement, specifically the section on executive compensation. Is the annual bonus tied to metrics that create genuine, long-term shareholder value, such as return on invested capital, ROIC, or growth in intrinsic business value per share? Or is it tied to vanity metrics like revenue growth, adjusted EBITDA, or, worst of all, the sheer size of the company? A bonus structure that rewards growth without regard to profitability is a recipe for value destruction. It incentivizes the CEO to become an empire builder. Part 3 is the passion test. This is more qualitative, but no less important. When you read interviews with the CEO or listen to them on earnings calls, What do they talk about with genuine enthusiasm? Do their eyes light up when they discuss the company's products, its history, its customers, and its competitive advantages? Or do they seem most animated when discussing financial engineering, mergers and acquisitions, and the stock price? An owner is in love with the business. A hired hand is in love with the deal. This is a subtle but critical distinction in CEO character. Part 4 is the simplicity test. How easy is it to understand the executive compensation plan? Is the proxy statement's description a few clear pages that a normal person can comprehend? Or is it a 50-page monstrosity filled with complex formulas, clawback provisions, and legal jargon, seemingly designed by consultants to obscure how much the executives are actually being paid? Complexity is often used to hide self-interest. A management team that is truly aligned with shareholders will have a simple, clear, and fair compensation structure that they are proud to explain. This incentive audit provides a rigorous framework for assessing the alignment of interests, a critical component of any quality investing strategy. The antithesis of the owner's mindset is the empire builder syndrome. This is the path of the 99% of CEOs who are driven more by ego and the desire for prestige than by the rational creation of shareholder value. The empire builder's primary psychological motivation is to preside over a larger, more important, and more talked-about company. Their self-worth is tied to the size of the enterprise they command. This leads to a predictable and often disastrous pattern of behavior. They pursue growth at any cost. They make large, transformative acquisitions, often paying a huge premium for the target company. The investment banking community cheers them on, eager for the massive fees these deals generate. The business press celebrates their bold vision. For a time, the CEO is a hero. The problem is that most of these large acquisitions destroy shareholder value. The promised synergies rarely materialize. Integrating two different corporate cultures is incredibly difficult. And the high price paid for the acquisition creates a massive hole that the company must dig itself out of for years to come. The empire builder doesn't care. They got their headline. They now run a Fortune 100 company instead of a Fortune 500 company. Their compensation has increased because they manage a larger entity. They have fulfilled their ego's desire, but they have done so with the shareholders' money. This behavior is a direct consequence of the principal-agent problem when the agent, the CEO, lacks an owner's mentality. They are playing with house money. A true owner, like Buffett or Murphy, is allergic to overpaying for acquisitions because they feel the pain of that overpayment personally. The empire builder feels only the thrill of the chase and the glory of the win. Investors who fail to recognize this syndrome are destined to fund the ego-driven ambitions of executives, watching as their capital is squandered on growth that benefits everyone but the actual owners of the business. This is one of the most common investment red flags, and yet one of the most frequently ignored. The direct financial connection here is best measured by the single most important metric in all of business: return on invested capital, or ROIC. ROIC tells you how much profit a company generates for every dollar of capital that has been invested in the business. A high and sustainable ROIC is the ultimate sign of a well-managed company with a strong competitive advantage. A manager with an owner's mindset is obsessed with ROIC. Before they invest a single dollar, whether it's building a new factory, launching a new product, or acquiring another company, they are asking themselves, what is the likely return on this investment, and is it higher than our cost of capital? If the answer is no, they don't do it. They would rather return the capital to shareholders through dividends or buybacks than invest it in a project that earns a subpar return. This discipline is the engine of long-term value creation. The empire builder, on the other hand, often ignores ROIC. Their focus is on growing revenue and assets. They will happily make an acquisition that grows the company by 50%, even if it cuts the company's overall ROIC in half. On the surface, the company looks bigger and more impressive. The income statement shows higher revenues, but the balance sheet is now bloated with low-returning assets. The company has become less efficient, less profitable on a per dollar of capital basis. This is how value is destroyed in plain sight. An investor who focuses only on revenue growth will be fooled. An investor who performs a proper stock analysis and focuses on the trend in ROIC will see the truth. A company with a CEO who consistently generates a high ROIC is a compounding machine. A company with an empire builder CEO who slowly erodes ROIC is a melting ice cube. The difference in their long-term stock performance will not be marginal. It will be monumental. It is the mathematical proof of the power of the owner's mindset. This leads us to our fourth pillar, a necessary exploration of the dark side, understanding the high cost of a tarnished crown and how reputational rot inevitably destroys shareholder value. We must study failure to truly appreciate success. Perhaps the most instructive story here is not one where Buffett avoided a scandal, but one where he ran toward one, armed with his unique understanding of reputation as a business asset. The year was 1963. And American Express was facing a crisis that threatened its very existence. A division of the company, which warehoused goods and issued receipts that could be used as collateral for loans, was caught in the middle of the great salad oil scandal. One of its major clients, a company run by a swindler named Tino De Angelis, had secured massive loans using American Express receipts for giant tanks of salad oil. The problem was, the tanks were mostly filled with water, with only a thin layer of oil floating on top. When the fraud was discovered, De Angelis's company went bankrupt, and the banks who had lent the money came to American Express, demanding they make good on the fraudulent receipts. The liability was potentially enormous, far exceeding the company's net worth. Wall Street panicked. The investment community assumed American Express was ruined. The stock price was cut in half. A cloud of financial fraud and incompetence hung over the entire brand. This is where the 99% of investors, driven by fear and headlines, sold in a panic. But Warren Buffett saw an opportunity. He began his own unique form of due diligence. He didn't just read the financial statements, he went out and investigated the company's reputational moat. He went to restaurants and saw that people were still using American Express cards and travelers' checks without hesitation. He talked to bank tellers and travel agents. He asked them if the scandal had changed their customers' perception of the core American Express brand. The answer was a resounding no. People trusted the green card. They trusted the travelers' checks. The fraud had occurred in a small, obscure warehousing division. The reputational damage, while severe in the headlines, had not infected the core business, which was built on a decades-long relationship of trust with its customers. Buffett concluded that the company's powerful brand, its reputational crown, was tarnished but not broken. He realized the market was overreacting, pricing the company for bankruptcy when its core earning power was still intact. He invested 40% of his partnership's capital into American Express stock. Within a few years, the stock had risen fivefold, and the investment became the foundation of his early fortune. This story teaches a critical lesson in risk management. Reputation is an asset, and the market can, at times, misprice that asset just like any other. Understanding the source and resilience of a company's reputation is key to both avoiding disasters and finding incredible opportunities. The psychological principles that drive these situations are the availability heuristic and the subsequent wave of panic selling. The availability heuristic is a mental shortcut that relies on immediate examples that come to a person's mind when evaluating a specific topic. When a major corporate scandal breaks, the news is everywhere. It's vivid, it's emotional, and it's inescapable. The story of the fraud, the disgraced CEO, and the plunging stock price becomes highly available in the mind of the average investor. This triggers a powerful emotional response: fear. The fear of losing everything, of being the last one out the door, overwhelms rational analysis. This leads directly to panic selling. Investors sell first and ask questions later. They are not differentiating between a scandal that is a terminal cancer at the heart of the business and one that is a treatable infection in a non-essential limb. All they see is the scary headline, and their instinct is to flee. This is precisely what happened with American Express in the salad oil scandal. The 99% of investors were driven by the highly available, terrifying story of the fraud. They panicked and sold, driving the price down to irrational levels. Buffett, by contrast, deliberately counteracted the availability heuristic. He ignored the dramatic headlines and went in search of boring, on-the-ground data. He systematically collected information about the health of the core business. This methodical, unemotional process allowed him to see that the market's panic was a massive overreaction. He was able to separate the vividness of the scandal from the underlying economic reality. Mastering this psychological discipline is essential for portfolio protection. You must be able to calmly assess whether reputational damage is fatal or merely a flesh wound. The ability to think clearly when everyone else is panicking is what separates the victim of the market from the master of it. To develop this skill, we can use an applied mental model called the reputational moat assessment. This is a 4-step framework for analyzing a company in the midst of a crisis to determine if its long-term value is truly impaired. Step 1. Identify the source of trust. Where does the company's reputation primarily come from? Is it tied almost exclusively to a single, charismatic founder or CEO? This is a high-risk situation, often called keyman risk. If that individual is disgraced, the entire company's reputation can be shattered. Or is the reputation embedded more deeply in the brand itself, the corporate culture, and a long history of reliable products and services? A brand-based reputation, like that of Coca-Cola or Johnson & Johnson, is far more resilient than a leader-based one. Step 2. Assess the severity of the breach. What was the nature of the ethical lapse? Was it the act of a single rogue employee in a remote division? This is often containable. Was it a systemic failure of culture, where thousands of employees were incentivized to act unethically, as was the case in the Wells Fargo account fraud scandal? This is far more serious, as it suggests the rot is deep within the organization. Or, worst of all, was the unethical act directed from the very top by the CEO and the board? This is often fatal, as it destroys all credibility. Step 3. Analyze management's response. This is often more important than the initial event itself. Did the management team immediately deny the problem, deflect blame, and attack the media? This is a sign of a company that doesn't understand the value of trust. Or did they, like Buffett at Salomon Brothers, take immediate and transparent ownership of the problem, fire those responsible, apologize sincerely to customers and shareholders, and implement concrete steps to fix the underlying issues? A swift, honest, and comprehensive response can actually strengthen a company's reputation in the long run by demonstrating its commitment to business ethics. Step 4. Evaluate customer stickiness. How easy is it for customers to leave? For a social media app that violates user privacy, customers can switch to a competitor with a single click. For a large industrial company's long-term corporate clients, switching suppliers is a complex and expensive process. For a bank, even one mired in scandal, the hassle of moving accounts, direct deposits, and automatic payments creates a degree of customer inertia. The higher the switching costs, the more time a company has to repair its reputational damage before its core business is permanently eroded. This framework provides a structured way to think through a crisis, moving beyond the emotional headline to a rational assessment of long-term business reality. The antithesis of this careful, analytical approach is the too-big-to-fail mentality. This is a form of corporate arrogance that leads to the greatest ethical collapses. It's a belief, shared by both managers and some investors, that an institution is so large, so important, and so embedded in the financial system that it can survive any scandal. This mentality breeds complacency and a culture of risk-taking, where the potential rewards are seen as far greater than the potential consequences. The managers believe that if things go truly wrong, the government or the Federal Reserve will bail them out to prevent systemic collapse. This creates a moral hazard, where there is no real downside for catastrophic failure. The lead-up to the 2008 financial crisis was a perfect example. Large investment banks took on staggering amounts of leverage to bet on complex mortgage-backed securities. Their internal risk management models were flawed, and their corporate governance was weak. But the belief that they were too big to fail allowed them to ignore the investment red flags. They saw massive fines from regulators not as a warning sign but simply as a, quote, cost of doing business. This demonstrates a complete breakdown of ethical investing principles and a focus on short-term profits at the expense of long-term stability. When the housing market turned, the house of cards collapsed, leading to the worst financial crisis since the Great Depression. The shareholders of firms like Lehman Brothers and Bear Stearns learned a brutal lesson. While the system may be too big to fail, their individual companies were not. Their equity was wiped out completely. Trusting in a company's size and importance as a substitute for genuine management integrity and sound business ethics is a fool's game. Reputational rot can and will destroy shareholder value, no matter how large the crown. The direct financial connection between a reputational collapse and the numbers you see on the financial statements is brutal and swift. Let's trace the impact of a major financial fraud scandal across the three core statements. First, the balance sheet. On the liabilities side, you see a sudden and massive increase in legal reserves, as the company sets aside billions to pay for expected fines and lawsuit settlements. On the asset side, you see huge write-downs of goodwill and brand value, as the company is forced to admit that these intangible assets have been permanently impaired. The company's book value can be cut in half overnight. Second, the income statement. Revenue plummets as angry customers boycott the company and corporate clients cancel their contracts. Simultaneously, expenses skyrocket. Legal fees, regulatory fines, and the cost of implementing new compliance systems create a massive drain on profitability. A company that was once earning billions can suddenly be reporting huge losses, quarter after quarter. Third, the cash flow statement. The lifeblood of any business is its ability to generate cash. During a scandal, cash flow turns violently negative. The company is bleeding money to pay for legal settlements, customer remediation, and operational losses. This often forces them to take on expensive debt or sell off valuable assets just to stay afloat, further destroying long-term value. The case of Enron is the ultimate cautionary tale. In early 2001, it was one of the largest companies in the world, with a stock price over $90. By the end of the year, after its massive accounting fraud was exposed, the stock was worth less than $1. The balance sheet was revealed to be a fiction, hiding billions in debt. The income statement was built on phantom profits. The cash flow was non-existent. It was a complete and total wipeout, a stark reminder that when management integrity fails, the numbers on the page become meaningless, and the destruction of shareholder value is absolute. This brings us to our fifth and final pillar, where we synthesize everything we've learned. This is about building a fortress of character, a method for constructing a portfolio that is not just diversified across industries, but is fortified by the integrity of its leadership, making it fundamentally more resilient to the risk of ethical collapse. The greatest illustration of this principle is not a single company, but the partnership at the heart of Berkshire Hathaway itself, the 60-year collaboration between Warren Buffett and Charlie Munger. Their relationship is the ultimate testament to the power of building an enterprise on a foundation of absolute intellectual and ethical integrity. Their decision-making process is a continuous, rigorous application of the newspaper test. They are famous for the deals they didn't do. They walked away from countless opportunities that looked financially attractive on the surface but felt slightly off from a character perspective. They refused to do business with people they didn't trust and admire, regardless of the potential profits. This discipline, this willingness to say no, is the core of their portfolio protection strategy. Charlie Munger often talks about the importance of earning the reputation you deserve. This philosophy permeates every aspect of Berkshire Hathaway. They acquire businesses not to flip them or strip them for parts, but to own them forever. They allow the excellent management teams of their subsidiary companies like See's Candies or Nebraska Furniture Mart to continue running their businesses with almost complete autonomy, trusting in the character they vetted so carefully during the acquisition. This creates an ecosystem built on trust, not on layers of bureaucratic oversight. The result is a corporate fortress, a collection of high-quality businesses run by high-quality people, all aligned with a long-term, owner-oriented philosophy. This is not just ethical investing. It is the most rational and profitable form of quality investing imaginable. The psychological principle that explains the extraordinary success of this approach is what Charlie Munger famously calls the Lollapalooza effect. This is Munger's term for the powerful outcome that occurs when multiple psychological biases and positive feedback loops all act in the same direction, amplifying each other to produce an extreme result. A portfolio built on a foundation of management integrity creates a positive Lollapalooza effect. You have the power of rational capital allocation from owner-minded CEOs. You have the power of customer loyalty from a reputation for fairness and quality. You have the power of lower capital costs from the trust of lenders and investors. You have the power of attracting and retaining top talent, because great people want to work for ethical leaders. All of these factors combine and compound on each other, creating a virtuous cycle that produces results far beyond what any single factor could achieve on its own. Conversely, a portfolio that ignores CEO character is a ticking time bomb, a reverse Lollapalooza waiting to happen. In a company with poor corporate governance, you have incentive-caused bias leading to short-term thinking. You have the social proof of a corrupt culture, making unethical acts seem normal. You have the overconfidence of an arrogant CEO taking reckless risks. These negative forces also feed on each other, creating a vicious cycle that almost inevitably leads to a blow-up. Building a fortress of character is about systematically constructing a portfolio that harnesses the power of the positive Lollapalooza and ruthlessly avoids the negative one. It's a recognition that in the complex system of business, culture and character are not soft inputs. They are the master variables that amplify everything else. To put this into practice, we can use a final mental model, the circle of competence and character portfolio strategy. This is a 4-step blueprint for building your own personal fortress. Step 1. Define your ethical baseline. Before you even look at a single stock, take the time to write down your personal, non-negotiable ethical standards. What industries will you refuse to invest in, regardless of their profitability? Are there specific business practices such as predatory lending or environmental damage that you find unacceptable? This isn't about judging others. It's about defining your own principles. A clear ethical baseline acts as a powerful first-level filter, simplifying your investment universe and ensuring you are never tempted to compromise your values for a profit. This is the foundation of true ethical investing. Step 2. Build a watch list of integrity. Instead of starting with a stock screener that looks for cheap PE ratios, start by creating a list of companies run by managers you genuinely admire. These are the CEOs who write clear shareholder letters, who have a long track record of smart capital allocation, and who demonstrate a passion for their business. Follow these companies for years before time you consider investing. Read everything they publish. Listen to every conference call. Get to know the character of the management team as well as you know the business model. You are investing in people first and businesses second. Step 3. Apply a character discount. When you are valuing any business, you must quantify your assessment of its leadership. If you have complete and total faith in the CEO character and the company's corporate governance, you might value the business at, say, 20 times earnings. If you have some minor concerns, perhaps the compensation plan is a bit too generous, or the CEO is a bit too promotional, you must apply a specific discount. You might decide the business is only worth 15 times earnings because of this added character risk. This forces you to translate your qualitative judgment into a quantitative decision, preventing you from overpaying for a great business run by mediocre or questionable people. Step 4. Concentrate on quality. Instead of spreading your capital thinly across hundreds of companies whose managers you don't know, diversification, concentrate your investments in a smaller number of businesses, perhaps 10 to 20, where you have a deep conviction in both the quality of the business and the integrity of its leadership. This is the opposite of the conventional wisdom, but it is the true path to superior long-term investing returns and robust portfolio protection. It is an acknowledgement that you cannot possibly conduct deep due diligence on hundreds of companies, so you must focus your energy only on the very best. The antithesis to this disciplined approach is the diversification delusion. This is the path of the 99% of investors who are told that the only way to be safe is to own a little bit of everything through index funds or exchange-traded funds. While this strategy protects you from the catastrophic failure of a single company, it comes with a massive, hidden cost. It guarantees that you will own your share of the crooks, the incompetents, and the value-destroying empire builders. When you buy an S&P 500 index fund, you are outsourcing your most important job as an investor, the vetting of management, to an algorithm that only cares about market capitalization. You are abdicating your responsibility to choose your business partners wisely. You are making a conscious decision to partner with both the Tom Murphys and the Adam Neumanns of the world. This approach may provide market average returns, but it forfeits the opportunity to achieve market-beating results by concentrating on excellence. It is a passive acceptance of mediocrity and a blind exposure to the ethical failures that inevitably occur within any large, uncurated basket of companies. The fortress of character is built on active, informed choices, not on passive, blind allocation. It is a commitment to the idea that who you invest with is just as important, if not more important, than what you invest in. Finally, let's look at the direct financial connection, the ultimate mathematical reason why this entire philosophy is so powerful. It comes down to the unforgiving logic of compounding and the devastating impact of the zero. The magic of long-term compounding is driven by earning consistent, positive returns over many decades. The greatest enemy of compounding is not low returns, it is large losses. A single investment that goes to zero due to financial fraud or reputational collapse can wipe out years of hard-won gains from your other successful investments. If you have a portfolio of 10 stocks and one goes to zero, the other 9 don't just have to perform well, they have to perform brilliantly just to get you back to even. Building a portfolio based on management integrity is, at its core, a strategy for ruthlessly minimizing the probability of ever investing in a company that can go to zero. It is the ultimate form of risk management. By filtering out companies with questionable leadership, opaque financials, and misaligned incentives, you are systematically removing the most likely candidates for catastrophic failure. It is not primarily a strategy for picking more winners, it is a strategy for avoiding the losers. And over a long investing lifetime, the mathematical impact of avoiding those big, predictable losses is staggering. It is the difference between mediocre returns and true wealth creation. The final promise of the newspaper test is not that you will never lose money on a stock. It is that you will dramatically reduce the chances of losing everything on a stock, and in the game of compounding, that is the most powerful advantage you can possibly have. You have just spent this time acquiring a powerful mental tool. You have moved beyond the simple numbers of stock analysis and learned to see character as capital, to understand management integrity not as a soft virtue, but as the hardest financial asset a company can possess. You now have a framework, from the newspaper test to the incentive audit, to build a portfolio that is not just a collection of assets, but a fortress of character, designed to weather the storms of market panic and corporate scandal. This is an incredible advantage. But it is crucial to understand that Warren Buffett's system is not a single pillar, it is an interlocking architecture of mental models. Mastering the art of judging the jockey, the manager, is only one half of the equation. A great manager running a terrible business will see their talents wasted. The next critical piece of the map is learning how to judge the horse, the business itself. It's about understanding the concept of a durable competitive advantage, or what Buffett calls the moat. The video that is now appearing on your screen is the missing link. It is the bridge that connects a great manager to a great business. While the principles of character protect you from ruin, the principles you are about to discover are what create unimaginable wealth. Think of it this way. You've just learned how to build the foundation of your fortress. The next step is to build the impenetrable walls. For those who are content with simply avoiding disaster, the journey can end here. But for those of you who are determined to complete your mental arsenal, for those who see investing not as a hobby but as the craft of a lifetime, the path forward is clear. The choice to click is not about watching another video. It is a declaration that you are ready to take the next step in your ascent. Complete the map. Build your fortress. The next piece of the puzzle awaits.